Hi, there we go. Hey everybody, it's Leon from Premier House's team of Triwood Realty, and I've got my favorite lender, Jeff Miltenberger from NFM Lending. We're doing our little annual, kind of semi-annual catch up, and I wanted to catch up with Jeff today because with the rates dropping a little bit last week, he had said something to me that kind of startled me, and I wanted to get his take and get him to tell you what programs he has to offset it. When I said rates going down, is that good? He told me when rates go down and on paper, they usually go up. And I was like, whoa. So, Jeff, school us.
Well, I think, a lot of when the feds drop rates, what we find out is that in anticipation of them knowing that they're going to drop rates, which the market sometimes does know, and in this case, we kind of had a good inclination that they were going to drop rates after a really negative jobs report that we got in September. So rates started to go down well before the feds even lowered rates at that point. So by the time the feds lowered rates, it's kind of already built into the market. So typically what we do see is like a little pullback, now the feds, what's the next report that we're waiting for? It might be profit taking. Maybe some people are pulling their money out of the market with the gains that they got, depending on what the situation is there. There could be a lot of different reasons that the rates pull back. And we did see the pullback. We saw a pullback. The feds lowered rates and rates actually went up a little bit, but they were lower probably by a good 3/8%, leading up to that point. So we got better rates right now. And now that we got another week jobs report yesterday with the ADP, or actually it was Tuesday, I believe, Tuesday, they're showing a loss of 33,000 jobs. That was a huge opportunity there for the market. And from that jobs report, we now have 100% supposedly, they're for the next Fed cut in October is 100% that they're going to drop rates right now. Now that can change obviously, but right now the sentiment is the Feds are going to drop in October, and then December, which is their next meeting. So they skip November and then they have a meeting due in December. The numbers on that one went from somewhere around 72 to 77% and skyrocketed up to 92%. So I think the idea of getting two more rate cuts by the end of the year is pretty positive, and I think that is going to be something that we're really focusing on. The market hasn't overreacted to the positive yet and saw rates drop, but we're definitely heading down, back down into those same levels that we saw right before the Feds did drop rates. Now, the next reports that we're looking at are going to be the inflation reports coming up in the next couple of weeks. The personal consumption, or not personal consumption, producer price index and the consumer price index. Now, of course, with the government shutdown, who knows if we'll see any reports? We're supposed to get the big BLS jobs report tomorrow, and there's a lot of hype around that to see if that was going to come out weak. But now that the government shut down, we won't get that report. So we'll kind of be on pins and needles, and the market will really be a little bit directionless, I think, until we get some more information from that. So let's hope this government shutdown ends quickly and we can move, back on to tracking what's going on in the economy and see if that's going to help us get some lower rates here by the end of the year.
That is a big thing. People are scared. I'm out of the Midwest. The soybean folks are worried for the farmers because now that China's buying from Argentina. So tariffs and the impact on that. What are the tariffs doing to the lending side of things?
You know, it's just mixed right now. We're not seeing a ton of impact from the tariffs, quite frankly, and tariffs are really more of a one-time hit. So it's not like an ongoing increasing thing that's going to continue to affect inflation. But it hasn't had much of a big impact. I mean, certainly, we got CPI, which is the consumer price index, and the PPI, the producer price index, and they have shown some, increases here and there. The PCE, personal consumption expenditures, came out at the end of last month, and that did show, inflation ticking up a little bit. But again, I think the idea in the markets kind of shrugged that off. They kind of knew that the impact of the tariffs was going to be a short-term, short-lived thing. So I think the anticipation is over the next 3 to 4 months to see if, we get a little hit up in inflation, but then it starts to come back down.
Yeah.
A big factor in that is going to be rents. Rents have been dropping significantly month over month over month. But unfortunately, in a lot of these inflation reports, like the CPI, the PPI, and even the PCE, they're looking year over year. So they're tracking numbers from a year ago. So the numbers recently, most recently, are coming down and showing rents dropping significantly. So as we move into next year, I think we're going to start to see those lower rents filter into these reports, and we're going to start to see inflation come back down pretty significantly. Mainly because rents like housing and shelter have a big impact on those reports. For example, in the CPI, the Consumer Price Index report, 46% to shelter. So if you're using a number from 12 months ago and shelter really doesn't come down, or maybe even shelter was slightly higher back then, I mean, it's going to have a big impact going forward. So add that in with the impact of the tariffs and you get inflation going up. But going forward, even if impact from tariffs stay, relatively consistent, the drop in rents and shelter costs will go down, and that should help still allow inflation to come down. And that's going to be something else that's going to help the Feds continue to lower rates too. But I think they're more focused right now on most of the Fed presidents are going to be focused in on the jobs market. And I think that's going to continue to weaken from what I've been seeing.
The other thing is with housing inventory up now and days on market longer, with there being more selection out there, people wanting to rent still have to compete with the fact that people are now able to look at having better selection to go buy a home.
Yeah, and the wealth building power of home ownership, I mean, that's what we really got to get out there is I think a lot of people are like, oh, just need a place to live. And I'm like, buying a house is not a place to live. It's like a huge investment that's going to generate a ton of wealth over time. They do a study every year. It's called the renter versus home ownership net worth study. And they've done it for years and years and years. The newest one just came out for 2024, and it showed that the average homeowner has 42 times greater net worth than the average renter. So the average renter has $10,000 in net worth. The average homeowner has 415,000 or something like that net worth. And really the only difference there, Leon, is guess what? They own a house. And
So
it's just the equity growing over time. So if you're
yeah,
renting, you're paying someone else to gain wealth and build serious long-term assets. And if you're buying, you're building your own wealth and your own assets. So home ownership is hands down one of the best investments you can possibly make. And you need a place to live, so why not buy it? You
yeah,
know?
and I tell people, short of a sinkhole coming up in your yard, appreciation on homes doesn't go backwards.
Yeah.
It's always going to move forward. It might not be the ridiculous 15 or 20% of a few years ago when people were losing their mind, but even at 8 to 10%, you're not getting that in the bank. You're not going up and down like the stock markets. That's the most solid investments you're going to get, which is why they say that is the biggest investment people make in their lives.
Yeah.
That takes
Most
us to the
people, yeah,
next
for
one.
sure.
I know you got some programs. How are you going to
Yes.
help people make this happen?
Well, and I love that we're leading into this. I mean, a lot of people aren't buying right now because of the high rates. They're going to wait for the lower rates. And I mean, you and I both know if we wait for the lower rates, that prices are going to, there's buyers going to come out. We have inventory right now, which is great, and it makes it more of a buyer's market right now. We're able to negotiate closing costs and things like that. But I think the biggest hurdle for a lot of clients that I talk to over my career of doing this over 30 years is, it's always comes down to I want more down payment. I don't have any money for a down payment, or I want to put more down on a house. And in reality, the beauty of real estate is leverage, in my opinion. You can buy this massive asset, 400, 500, $600,000 asset, and you can put as little as zero down. And yes, I did say zero down. And no, this isn't the lead into another 2008. These people, when you get a zero down loan, you actually have to qualify for it. It's not stated income or give me what your number of income is
Yeah,
so you can
not
qualify for the
not a
loan if they give
liar's
you a
loan.
loan.
Yeah, I'll say it. Not a liar's loan.
Yeah, the liar's loan, exactly. These aren't liar's loans. I mean, they're offered by the state of Washington, a lot of them. And, it just allows people to get in without having to come up with any money down. Because it's a seller market, it makes these programs even more ideal because then I know, Leon, you're a great negotiator. You can go in there and say, hey, Mr. Seller, we want $10,000 for closing costs. And we use it. And you walk in with no money down and even potentially get your earnest money back. Now, with that said, as we transition into lower and lower rates, some houses are going to be more competitive and you might not be able to get your closing costs covered. So, in response to that, NFM Lending came out with a program where we now offer not only down payment assistance, but we also cover the closing costs with a program that's exclusive to NFM. It allows us to really help people get into a house. And even in a competitive situation, we can still go in strong, not ask for any concessions, and still allow that client to move into that house without any money down. And we'll cover not only the down payment, but also the closing costs as well. So it's just another great opportunity making homeownership more possible and helping people get into houses so that they can start building wealth. That's really my main driver, to be honest with you, that gets me excited is the wealth building part of it. The sad part of it is, and maybe it's not sad, but it's interesting in my opinion, is they also did another study. I think this is a couple of years ago, where they were like, what are the most important parts of owning a house to you? Like, why is home ownership so important? And one of them was like, I have, I can do what I want with the house. I can have pets. I can, change the paint color. I can, have all these things, all these benefits of home ownership. And the last one on the list was wealth, building wealth.
People
That
don't
stunned
understand.
me.
Well, people, no, not really. What you'll find, and I say this just flat out, people don't understand how money works. They'll sit there and they don't understand. So when you said leverage, that was very important because if I can take basically at this point a zero down program to buy a house and I control a $600,000 house, that's leverage. The wealth generated from equity was, and I tell people, even buying your first time home, the idea is not to pay the house off. That's not where it's created. The equity of the house builds can now be used to leverage where you want to go when you go into that second home, third home, final home, however. So it's understanding money. So I totally understand why the last thing was wealth because they don't understand how to make that money work for them. But that's why you and I are here.
I love that. That's a great feel of there that too way. And I don't think people understand how you're right, money works, but then also how appreciation and housing is like leverage is all about how little money can I put into an investment and get growth out of it. And then you kind of calculate your return. Like I always relate it to buying a stock. Like if you want to buy a share of stock, say it's $100 share of Microsoft. Let's just say $100 for round numbers, and that stock goes up 10%. You just made 100 or $10 or whatever, right? But but you had to put that $100 out.
Yeah.
If you look at a house and you get in with either zero down or even 5% down, but let's say zero down, you buy a $500,000 house and that house goes up by 10%. That house just went up by $50,000 and you didn't put a penny into it. That's the
In one
power
in
of
one
real estate.
year. In one year. And
Yeah, it's
it's not a
crazy.
roller coaster. I tell people, get off the roller coaster. It's not a roller coaster. It's a necessity. Food in the fridge, roof over the head, clothes on your back. We want it's Maslow's theory of needs and what have you. And that's really what you get.
Yeah, and I mean, if you look at real estate in general as a whole, as an investment too, like you were bringing up roller coaster, real estate's not a roller coaster in reality. If you look back, they started tracking appreciation for housing markets in 1942, and since 1942, there's been 75 increasing years in real estate, 7 losing years where the market went down, and 1 even year. The 7 losing years, guess where 5 of those losing years were?
That had some probably was 7 through whatever, but that was
Yes.
what I call a market adjustment because
Yep.
it couldn't sustain an unrealistic thing.
That was the only market that had that 2007 through 2011, 12 is exactly right where you're talking about. That was the only market that had greater than a 1% loss in any
Yeah.
given year was those 5 years. So if you take those out, because those are anomaly, those were fake loans. You called them liar loans. That's exactly what they were. They shouldn't have been securitized. I mean, the financial big banks or whatever took advantage of us. The other 2 losing years out of those 7 is 1990 and 1991. 1990 was a just under 1% loss,
Yeah.
and 1991 was a fractional loss, not even close to 1%, less than 1/10 of 1%. Those are the only 2 losses. Everything else is green, and the numbers are massive. Like decade over decade over decade, year over year over year, we're seeing double-digit gains almost every year. Now, another slowdown happened this year, this decade, after the pandemic. So 2020s, right now that we're in, was a slower year for the last couple of years, which means values have slowed down, again, making it a better opportunity to get in without jacking up the prices. But a lot of people are saying, like, oh, we're waiting for the market to go down. I mean, historically, the
It's not
market
gonna,
doesn't go down.
yeah. I have a picture of a skeleton sitting on a couch where he's got that number still waiting to be served. That's what people need to understand. You'll be the skeleton on the
You got
couch,
to share that with
still
me. That's
waiting. It ain't gonna
fantastic.
happen. Yeah, it's still ain't gonna happen.
Values are
I
coming
got a
down.
picture of me sitting next to it laughing.
Oh,
But
that's
yeah,
awesome.
and that's the honesty behind it. And this is what I say about, your job and mine is helping people to understand. I tell people I don't sell you a house for you to lose it. I want to get you in somewhere that you're going to be comfortable, that you can stay, not live for the place you're in. Living for the place, it's no good, and that's why, programs like what you have and sit them down with you, making them understand what the program is, what it does for them. That's the purpose of what I do.
And I agree. And these videos are really powerful, I think. And I hope everyone out there that watches this video, the one takeaway is you don't want to listen. I, I compare advice in real estate to advice going to a doctor or something like that. Like, if if you broke your arm and your arm really hurts and you think it's broken, you don't go to your mom or dad or someone at work and say, "Hey, what do you think of my arm? Do you think you can put a cast on it?" You go to a doctor, someone that has experience, someone that can fix your arm and give you exactly what you need to get it tied up. And the same thing in real estate. I think a lot of people go to their mom or dad or people at work and they buy one house every 10 years and they're like, "Oh wait, values are going to go down, interest rates are too high, this is a terrible time to buy." And at the same time, I think it's one of the best opportunities I've seen in 30 years of doing real estate. I think this is one of the best markets you can grab in. Yes, prices are high, yes, rates are high, but when rates drop, values are going to go up. And I'm not one of those people that just talk the talk. I also walk the walk. I bought a house in 2023. I forced one of my employees that never thought she was going to own a home again buy one in 2024. I mean, I think it's a strong opportunity. And both those houses, by the way, the one I bought and the one my employee bought, have both skyrocketed in value over the years. And I think that's exactly what we're heading into. Rates are going to drop. More and more buyers are going to come into the market. There's going to be competition. That's going to press values higher, um, at long term
Yeah.
and short term for that matter.
Yeah, there'll be overbidding and less opportunity because especially here in Washington State, things shrink quick. We have traditionally been one of the hardest states as far as inventory wise to maintain. We got to the point where before they say a healthy market was 4 to 6 months, we were doing a happy dance if we got to 2 months. But generally speaking, we were 3 or 4 weeks of inventory for the longest. We have been one of the toughest states. So the thing is, when you see even builders offering incentives trying to get you in there, it's good. But I caution people in dealing with builder incentives, they have to understand once again about money. Because what you'll go find in the research is that a lot of times you're paying for what you thought was that benefit in the increased price of the home and what have you, versus having someone that's going to come in and negotiate because the builder still has a bottom line. And even if I'm coming in asking for closing costs and this and that, negotiating by coming in with you being my lender, what happens is they're going to get a better rate. They're going to get a lower price. We're negotiating the closing costs, and once again, they're taken care of because the people on site work for the builder. They don't work for the buyer. And that's something they have to understand where when they come in going, well, I'll just work directly with that person. I'll get a better deal. Probably not. And
No,
so
and
that's,
I'm so glad you brought that up because that is kind of like that little known factor on new construction. I saw an offer from one of my clients that I've been working with for months. They ended up buying a new construction and they were going to get 499 FHA loan from their builder. And I'm like, I can't compete with that. You're going to have to go with that. But, I started to do some research on that. And you look at these big builders, like, and I guess I shouldn't say any names just in case,
we
but
won't.
kind of the way it works is they find out, like, how do we offer 499? Oh, we're going to have to pay $20,000 to buy the rate down. Well, they
Yeah.
have their own lender. They go to their lender and say, what do we need charge wise? 20,000. Then what the builder does is they just raise their price by 20 grand and put their house on the market and they're like, yeah, we got this great house. It's 20,000 over what it's actually worth, but I'm going to give you 499 to make you think you're getting a great deal. And
Yeah.
in reality, that 20,000, even if you got 499, it takes years and years to recoup that money
Yeah.
before you get there. So the argument is what if we got 6.5 instead of 499 and we just waited a year and rates dropped down to 499 and then I refinance and get 499 and it doesn't cost me anything. You probably just saved yourself $10,000,
Or the
if
offset
not more.
also, The offset also, so I came and got it for 20,000 cheaper for where the payment's sitting at already. When I come back
Yeah.
and do the refi later on, I'm still way ahead of the game.
And when they do that, when they build that up too, sometimes it's going to take the value a much longer time to increase because you've just paid 20,000 over in a flat market. The other houses are kind of moving sideways, and now you've overpaid. And even when the market starts to go up, it's going to take a while just to get to the value that you paid for that thing, and it might take even longer to refinance again down the road. I mean, there's a lot of things that you got to consider when you're buying new construction and getting this great rate buy down that's offered by the builder because they're definitely not. Matter of fact, I think, I mean, I'm not 100% on this, but I know a lot of builders are doing earnings calls right now and they're coming in stronger than ever. And a
Yes,
big
no,
part of it is
I've read
just what I
that.
said. They're getting
I've
a
read
lot of
that.
traction and getting people excited because they're getting a low rate, but they're jacking their prices and they're still making full profit on those houses. So, got to watch ourselves out there for sure.
No, so real quick, I'll tell you what, run a couple of your programs by. You've got the zero down program, but I know you had several others that people could benefit as well from.
Yeah, we got the zero down program that can also cover the closing costs as well, which is a great program. We've got a couple of specialty programs. One we just came out with that I was kind of excited about it is we don't see it a lot, but if you have an ITIN instead of a social security number, which there's a lot of clients out here like that, we now have a 10% down ITIN loan that allows people that don't have an actual social security number that are here with we just using an ITIN, we can get them qualified just so people know ITIN is the tax identification number. So some people coming into the country may not have a social security number yet, so they work on an ITIN. That's where they run their W-2s and stuff through. It's harder to qualify for a loan like FHA, conventional, and loans like that don't allow for ITIN, but we now have a product that does allow for only 10% down, which is pretty amazing. It's always been 20% down, which is a hard reach. But now that 10% down is available, it could be mean a lot more for a lot of clients out there that are looking to buy as well. I always love doing VA. VA is an amazing opportunity. I love working with veterans and active military. As you know, Leon, and we always offer a 2% lender credit back to the client, 2% of the loan amount on any of our veterans and active military so that we can help them either buy down the rate, cover their closing costs, and or potentially um, pay off their own personal debt. So I don't know if you probably know this being the veteran yourself, but VA does allow you to use proceeds from a purchase to potentially pay down some personal debt as
Yep.
well, which is amazing. I've done it 3 or 4 times in my career. Doesn't happen often, but when it does, it could help someone qualify for a new loan, open up some cash flow. And this is the kind of market where you can do that.
Yeah.
Like a slower market where sellers need to sell, we can negotiate more concessions and open up way more opportunities for our veterans and active military, which is always super important to me as well.
I've paid off cars and credit cards. So
Yep.
for those that are veterans like myself, thank you for your service. Just letting you know that just because a lender or another real estate broker tells you they can do VA, yes, they can, but it doesn't mean they know it. I've turned
Exactly.
around and I've been called out and challenged when I've been asking for debts and stuff like that to be paid, and they had no clue. So before you sit here, I say always do your research. But one thing I want to make sure that also people understand, in addition to VA, which is zero down, NFM does have a program for non-military that is a zero down program. And so that's something that you really, really look at how that helps you get where you're at. It's a strong program because I've
Yeah.
never heard anyone else offering it yet.
And a lot of people want to put more down. We talked about it earlier, and you're just chasing that value up. As longer you wait to save, you're saving up, and say even save $1,000 a month, the value is going up similar to that. So you're just chasing something that you'll never catch up on. Appreciation is a crazy thing that we got to watch out for. So you want to get that appreciation working for you as soon as possible. So even if you put zero down, a lot of people are like, I want equity in my property. I don't want equity in my property. I want to buy that thing and put as little down as I possibly can. And then I'm going to let that asset go on its own. So, again, coming back to leverage, leverage is a super powerful tool. And if you have no money for a down payment, I don't care. I think as long as you understand home ownership, going in with eyes wide open and the payment that you get is something you qualify for and feel comfortable with, we should start moving forward with the process and get you in, whether it's zero down, 5% down, or 50% down. I don't care. Just a matter, you got to get in the home and get that powerful asset working for you.
I'll give you a quick one to help go with that. When you buy a stock, it's worth what you paid for it at that time. So if you
Yeah.
bought a house and it's worth what you paid for it at that time, if you're understanding how stocks increase in value, that's what you're betting on, then you're understanding the house appreciation is going to go up. And that's a much safer bet because we know the housing market is more stable and not volatile like stock markets do. I could buy a stock for $100, wake up tomorrow, it's worth $50. Whereas when I buy that house, unless I got a sinkhole in the yard, it's going to be just fine.
Well, the other thing too is you get stocks only go up or down. Housing values, the way the leverage works is you got appreciation going up and you got the amortization, which a lot of people forget about, is every time you make a payment, a portion of that goes to principal. So your balance is going down, your value is going up over time. We just talked about values, like, oh, well, housing values can go up or down. Yeah, they can in different markets. I'm sure, like in Ohio or some other areas in the Midwest, you might see some depreciation in some cases, but like you alluded to earlier, Leon, is Seattle is one of the strongest markets that's in the entire US right
Yes.
now. We were the last one to go down in 2008. That's how strong it was. It took us at least another year before the rest of the country was crashing. And then finally, Seattle caught up down the road. But we're also probably the first one to recover as well coming out of that. I mean, our values have been strong and we just have a lot of good uh, uh,
Support in place.
yeah,
And
support in
I
place
say
to
that.
keep values going up. And then we look at that chart. I would love to share this chart with anyone that's interested. Shoot me a DM or IM on this thing, and we'll send over the chart. But it's literally going back to 1942. There's only 7 losing years, and 5 of them were in 2008, and the other ones were less than 1%. The housing market is a very resilient opportunity, and it's mainly because the government is supporting it. The
Yeah.
government is funding FHA loans and VA loans and USDA loans, and conventional is even a government-sponsored entity. The government doesn't want the housing market to fail, and they want everyone in the U.S. to, own a house. So you can't have that kind of support and see something just crash, if you know what I mean.
Yeah. Yeah. No, I totally agree. I'm gonna have you send me that chart as well.
I will. I'd love to share it with you. It's a killer chart.
Yeah. But no, I'm gonna tell you what. Thanks for today. I'm gonna go ahead. You'll see Jeff's information below when I send this out. If you have any questions for him or myself, feel free to reach out. We're here. It doesn't cost anything except the time you spend to do it. And that's probably the best use of time you'll ever be is getting information to make a decision about buying a home. And this way you have all the correct facts in front of you, not just the backyard advisor that doesn't know what they're talking about because they don't want to let you know that they can't buy a house from poor decisions. I just say it like it is.
Yeah, I love it. Thanks so much for having me on, Leon. Great talking
Hey,
with you, brother.
oh yeah, send me the chart.
I will. I'll do that
Bye.
right now.